Most people assume wealthy investors just buy more of what you're already buying, more index funds, more savings accounts, just bigger. They don't. The strategy itself changes at every level of wealth, and there's a clear, learnable pattern to how it shifts. Here's the full ladder from $1,000 to $100 million. Let's start with the bottom of the ladder, because this is where most people are and where the most expensive mistakes happen. At the $1,000 to $10,000 tier, your only job is to stop bleeding. That sounds harsh, but it's accurate. The biggest drag on a small portfolio isn't a bad stock pick. It's a savings account earning next to nothing while inflation quietly erases your purchasing power, and it's leaving an employer match on the table. That match, typically 50 cents on every dollar up to a percentage of your salary, is an instant return the moment you contribute. Nothing in the market reliably beats that on day one. So at this tier, the move is simple. Park your emergency fund in a high-yield savings account, capture every dollar of your employer's match, and stop there. No crypto. No individual stocks. Complexity at this stage costs you more than it earns you because the decisions themselves introduce risk before your foundation is solid enough to absorb it. Once you cross 10,000 and start climbing toward 100,000, the game shifts. You've eliminated the drag. Now you're building the engine. This is where low-cost broad index funds, a total market fund, or an S&P 500 fund become the core of your strategy. Not because they're exciting, but because a 1% annual expense ratio on a growing portfolio quietly costs you tens of thousands of dollars over a 20-year horizon. A fund charging 0.2% versus one charging 1.2% sounds like a rounding error. It isn't. That gap compounds the same way your returns do, just in the wrong direction. The second move at this tier is maxing your tax-advantaged accounts. A Roth IRA, your 401k, or both if you can manage it. The Roth is particularly powerful here because you're likely in a lower tax bracket now than you will be later, so you're locking in today's rate on money that grows tax-free for decades. And then, this is the part most people skip. You automate it. You set the contribution, and you remove yourself from the decision entirely. Because at the 10,000 to 100,000 tier, your behavior is the biggest variable. The market will do what it does. The question is whether you'll panic sell in a downturn or stay the course. Automation makes that question irrelevant. Now here's where it gets genuinely interesting. You cross $100,000 and something changes, not just in your account balance, but in what actually moves the needle. At this level, tax efficiency starts to matter more than chasing an extra 0.5% of return. Think about that. You're no longer just trying to grow the pile. You're trying to make sure the government takes as little of that growth as possible. That means adding a taxable brokerage account alongside your tax-advantaged ones, and inside it, being intentional about asset location, putting your least tax-efficient holdings in sheltered accounts and your most efficient ones in the taxable account. It also means introducing international exposure and a bond allocation that reflects your actual risk tolerance, not just a default. This is the first real diversification moment on the ladder. Not diversification for the sake of it, but because a $100,000 portfolio is large enough that a single concentrated bet can genuinely set you back years. Everything from $1,000 to $500,000 is still largely self-directed. You can manage this tier with discipline, the right account types, and low-cost funds. But the next tier, that's where the playbook fundamentally changes, and where strategies most people have never heard of start to become available. Right now, you're sitting somewhere on that ladder, so which tier are you actually at? Still building the foundation under 10,000, or already working the index fund engine toward 100,000? Drop your answer in the comments below. Either way, the next tier is where the rules stop being familiar, and that's exactly where we're headed. Now, past $500,000, the playbook you've been running stops being the most powerful version of itself. Not because it stops working. Index funds still compound, tax-advantaged accounts still shelter your gains. But above $500,000, a new set of tools unlocks that can generate more after-tax return than chasing a better fund ever could. And the first one most people have never even heard of. It's called direct indexing. Here's what it actually means. Instead of buying a fund that tracks the S&P 500, you own the individual stocks inside that index, hundreds of them, held directly in your account. The fund and the direct index perform nearly identically over time. But because you own the individual stocks, you can sell the ones that have dropped and harvest those losses to offset your gains elsewhere. You're essentially manufacturing a tax deduction out of normal market volatility without meaningfully changing your exposure to the market. Below $500,000, the transaction costs and management fees eat the benefit. Above it, the math starts working in your favor, and a fee-only financial advisor becomes worth the cost, because the tax savings they engineer often exceed their fee by a significant margin. This is the first tier where professional advice stops being a luxury and starts being an investment with a measurable return. Cross $2 million, and the portfolio construction changes in a more fundamental way. This is where real estate enters, not REITs, which trade on public markets and move with them, but direct property ownership or private real estate funds. Same shift applies to private credit and other alternative assets. The reason wealthy investors use these isn't prestige, it's correlation. These assets don't move in lockstep with the stock market, which means when public markets drop sharply, a portfolio with meaningful alternative exposure doesn't fall as far. That's not a small thing when you're protecting a multi-million-dollar base. The catch is access. Many private funds carry minimum investments of $250,000 to $500,000 per position, which is exactly why this tier only opens at the $2 million level. Below that, you simply can't diversify into enough positions to make it work without concentrating too much in a single bet. Above $10 million, the goal itself changes. You're no longer primarily trying to grow wealth. You're trying to protect it, transfer it efficiently, and make sure as little of it as possible gets lost to taxes along the way. That shift in objective drives every tool at this tier. Family office structures, either a dedicated team or a shared multi-family office, handle the coordination across investments, legal structures, and estate planning that becomes necessary when a portfolio is this large and complex. Private equity becomes a meaningful allocation, not a side bet. And estate planning vehicles like GRATs, grantor retained annuity trusts, and irrevocable trusts become primary tools, not afterthoughts. Because at this level, the estate tax exposure alone can represent tens of millions of dollars. Donor-advised funds enter the picture too, letting you take an immediate tax deduction on a large charitable contribution while deciding later where the money actually goes. Every one of these tools exists to solve a specific problem that only becomes expensive enough to matter above a certain threshold. That's the ladder. $1,000 to $100 million. And at every rung, the strategy isn't just bigger, it's structurally different. Solving a different problem, using tools that didn't exist or didn't make financial sense, one tier below. The through line is simple. Figure out exactly where you are. Use the tools that unlock at your level, and ignore everything designed for a tier you haven't reached yet. That's not a limitation. That's the most efficient path up. The biggest takeaway isn't that wealthy people buy different investments. It's that they solve different problems. At $1,000, your job is to build. At $100 million, your job is to protect. Every level of wealth comes with a new set of rules. If you enjoyed this breakdown and want to become a smarter long-term investor, subscribe to The Long Game. And if you're just getting started, watch the next video where I'll show you exactly how to choose your first index fund without all the confusing jargon.